अति परमार्थमय व्यवहार हो, ना हम रहे अपने लिए, हमको सभी से गर्ज है। गुरुदेव ये आशीष दे, जो सोचने का फर्ज है। हम हो पुजारी तत्व के, गुरुदेव के आदेश के, सचदेव के निकलेव के, के सत्कर्म के, हो सीध झूठी राह की, अन्याय की अभिमान की, सेवा करन को दास की, परवाह नहीं हो जान की। छोटे न हो हम बुद्धि से, हो विश्वमय से ईशमय, हो राममय और कृष्णमय, जगदेव में जगदीशमय। हर इंद्रियों पर ताब कर, हम वीर हो अति धीर हो, तो चल रहे सर से सदा, निज धर्म रख अति शुद्ध हो आचार से, तन मन हमारा सर्वदा, आध्यात्म की शक्ति हमें पल भी नहीं कर दे जुदा। इस अमर आत्मा का हमें हर श्वास भर में गम रहे, गर मौत भी आ गई, सुख दुख हमसे सम रहे।
I welcome everyone here on this webinar on wealth creation and wealth management. And not only this, today I am also pleased to inform that our partner firm, J. Kumar Tejwani and Company LLP, though they are associated with us for last 30 plus years, but at the same time, from 1st July 2026, the J. Kumar Tejwani Company LLP, founded by Mr. Tejwani, is now partner with Kalani and Company LLP, which actually, give the benefit of this collaboration to both the firm, where Mr. Tejwani ji and his firm is there at Delhi as well as Mumbai, NCR and Mumbai, and practicing mainly into the global taxation, I would say. So Mr. Tejwani ji is also there with us today on this topic of wealth creation as well as wealth management. We do also have Mr. Suraj Singh, Chartered Accountant, who will be the speaker on this subject. With this small introduction of J. Kumar Tejwani and Company LLP, I request Mr. Tejwani ji to please guide us on the topic today, as well as thereafter Mr. Suraj can take the topic in detail, and Tejwani ji can always moderate as well as guide the Mr. Suraj on the topic. So, Mr. Tejwani ji, over to you.
Thank you, Bhupendra ji, for such kind and beautiful words. And in fact, it is our honor to now be integral part of Kalani and Co. LLP. 30 years plus relation, when it materializes into such a wonderful alliance, it really gives us a lot of happiness, joy, and I'm sure we both are, as a firm, are going to grow. And good morning, everyone who's present here, and welcome to the 192nd Saturday webinar. My name is Jay Kumar Tejwani, and I am one of the moderators along with Bhupendraji for today's session, which is more on the wealth creation and management, presented by our expert, CA Suraj Singh. So Suraj carries a background of very rich knowledge in the wealth in his past experiences with some of the big firms like Nuvama, Deserve. So therefore, I thought Suraj could be the best person to talk about it. But today's session we have kept very simple. We have not included any complicated products as part of the wealth, and uh, and I'm sure it is going to benefit all of us, be it article assistant or the partners or the senior people, because the session talks more about the discipline, about the concept, about the way forward in terms of making the investments. So before I hand it over to Suraj, okay, and I am also supported by my team members in the room. Our CFA, CA Jyoti Tejwani is also with me. Our partner, CA Kamal Tejwani is with me. And team members in the office have also joined. Team members who are not in the office, they have also joined together. So welcome everyone, even from JKT and Co LLP. So I'll start with my own example. So when, it's almost 35 years ago, when we were in college year one, so our teacher who was teaching us accounts, he said, after 2 weeks, bring in 50 rupees each. And he gave us a form to fill in. तो उन्होंने कहा 50 रुपए लेके आना है आफ्टर 2 वीक्स ये फॉर्म है जो आपको भरना है अपनी एक पिक लगानी है और उस टाइम ये आधार वगैरह नहीं था तो कहते हैं एक राशन कार्ड की कॉपी लेके आइएगा सो वी वर ऑल वेरी नोवाइज इन द एज ग्रुप ऑफ 17-18 सबने बड़े शौक से वो फॉर्म भरा अपना अपना एक फोटो लगाया राशन कार्ड की कॉपी लगाई 2 हफ्ते के बाद 50 रुपए लेके सब आए एंड वी वर टेकन टू द स्टेट बैंक ऑफ इंडिया विच वॉज वेरी क्लोज टू आवर कॉलेज सब हैरान कि सर हम कहाँ जा रहे हैं नो यू आर गोइंग टू मेक अ लाइफ डिसीजन टुडे तो वहां पे हम सबका उन्होंने एक पीपीएफ अकाउंट खुलवाया 35 years पीपीएफ अकाउंट so that is how I got into the habit of investment then again another small example I think I'll give it right so when I joined an articleship with the very elite firm Vaseem Raghavan and company तो वहां पे they already had this section called wealth create your asset करके उनका एक छोटा सा डिपार्टमेंट था तो वहां पे हम गए तो उन्होंने बोला आपका क्या क्या इन्वेस्टमेंट है हमने कहा सर आप आर्टिकलशिप में स्टाइपेंड कितना देते हैं कि हम इन्वेस्टमेंट करें कहते नो व्हाटएवर यू हैव सम परसेंटेज हैज टू गो इन सम इन्वेस्टमेंट तो वहां पे आई लर्न इन्वेस्टिंग इन द आईपीओ और तब 10 रुपए का ही आता था इन्वेस्टमेंट यूज्ड टू बी जस्ट 500 मे बी तो these beautiful examples in fact right from the beginning imbibed me the discipline of investment. Okay, so I'll keep giving you these examples, but now I would be passing on to CA Suraj Singh to start with his presentation. So CA Suraj Singh, welcome.
Am I audible? Hello everyone, am I audible?
Yes, Suraj.
Yeah. First of all, hello. Yeah, first of all, thank you so much everyone for joining the meeting.
I think there are
Just yeah. Is it fine now?
Yes.
Hello. Yeah. So first of all, thank you everyone for joining the meeting. And this is in fact a very big moment for me to be addressing all of you. Before we start with the presentation and go on to the technical part of it, when I was having a discussion with Jay sir as to what I should be presenting, he told me to come up with whatever you have, right? So that kind of took me back to a prose line that I have read in the past. which is that this night sky is full of light, right? The black voids which are there are just a part of light which have not reached you. Right. So in practice, in CA practice as well, there are a lot of areas which we kind of do not touch upon, and we assume that the light is not there. And one of the major field where CAs should be trusted as a fiduciary is wealth management, right? So I'm just sharing my screen. Let me know if the screen is visible to you.
Yes. It is visible. Yes, it is visible. We are not able to hear you. Your screen is visible.
Just a moment. I'll join from another. Hello.
Yes, Suraj.
I'm sorry, there was some issue with my.
Yes, now you can continue.
So, before we begin with the presentation, I'll just take you through the basic agenda of this meeting. So, we'll be covering the foundations of wealth management and how one should be looking at wealth management and asset allocation. There will be some guardrails which I will be sharing with you that one should be considering before investing into any asset class, equity or debt. We'll also touch upon a little as to what is the scape around alternatives such as commodities and leverages available in India. We'll also go for what are the offshore investing horizons that one should be exploring, and how should a CA look at those offshore investing horizons, right? What I've done in this presentation, I've also put in some rules to investing, which are not a separate topic, but which are in the flow as we go, right? So they will better imbibe us with wealth management practice and how to look at the practice, keeping those rules in mind. It's a foundation of wealth management. What wealth means and what are the guardrails which decide as to where we should be investing. Now, when we come across the word wealth management, what do we understand, right? So I'll give you a simple example. जब भी हम लोग return filing या taxation का काम कर रहे होते हैं, it is always a post facto verb. What do I mean by that? Whatever you do in the whole year, you compile that data and then you go on to file the tax for that, right? But whereas in the wealth management, it is very forward-looking approach, right? So one has to predict or one has to plan in advance as to what they want out of their money for the next 10, 15, 20 years, right? So what is most important part of wealth management is the planning stage, right? At the planning stage, we should be very honest, evaluating our available resources and what are the goals that we want to achieve out of those resources that we have, right? Once that planning is done, and it is the basic main part of the whole discussion, then once the planning is done, we have to start strategizing, right? The second part of management, which is organizing, takes the shape of strategizing when it comes to wealth management. We have to understand what are the incomes and expenses, what are the buffer that we have every month, what is the buffer that we have created throughout life, and how to structure those investments into different asset classes so that we can achieve the plans that we decided upon. These two stages once completed, one has to go on to direction, which is execution in wealth management. One has to be very military fashion, executor when it comes to wealth management. A miss here will mean a lot of butterfly effect in the next coming decades, right? And the last but not the least is to control and report in the proper and prompt fashion, right? So these four pillars are the guiding principle how wealth management has to basically work. Now, if you see, this is the first rule which I was talking about. I'll keep filling a lot of rules. So the first rule where we say that we want to plan and execute is the 50-30-20 rule. This rule simply says that whatever you earn in any month, 50% of that can go to needs, 30% can go to wants, and at least 20% should be going towards savings. Now, why does this rule become very important, and why does this rule merit a place in the first discussion itself? Is the fact that every time you make more, you are inclined to spend more, right? Which is called lifestyle inflation. So in wealth management, inflation is the biggest enemy that one should be hunting upon. While we are always, looking at the economic inflation, we are at times ignoring out the lifestyle inflation, right? Which slowly creeps into our behavioral pattern. So if this rule of 50-20-30 is followed religiously, one can be very sure that the lifestyle inflation is not creeping in, right?
So what is lifetime
Now, the
inflation?
second rule, which is also very imperative at the planning stage itself, is the terminal value that you'll have. So in planning, whenever we are planning about anything, after 5 years, 10 years, we say, hey, we have to have a terminal value of the asset, right? Life as an asset should also have a terminal value fixed. So that rule is called 15-20x rule, where we have to at least have 15%, 15x to 20x of our annual earning as a term insurance, right? So whenever this asset is going to come to a termination, there has to be this much buffer, right? So first rule is whatever you're earning, you have to have 50-20-30 going into investments and lifestyle. And then second rule, you also have a safety net at all times, which is at least equal to 15-20 times of your annual earning. Now, once we have understood how to think about wealth management, we also need to understand the nuances which become very imperative for a wealth manager, for an advisor, for a fiduciary to guide a particular client or a particular investment decision, right? So the three core principles are return, risk, cost, tax and liquidity, and transferability. Whenever a client or a person would walk into your door and ask you where they want to invest, they'll always have a return expectation in their mind, right? That's where our job starts, to think about other things which he has not already thought about, right? So the first thing in that is risk. Second is how much money is going to shell off in terms of management cost, right? The second leg of risk is tax and liquidity. So I always believe that if you are earning, say, 14%, 15%, 16%, and a major part of it is going into taxes, ultimately you are not making the money for yourself, right? Wealth has to be a very selfish business as long as the client interest is concerned, right? So the least amount of tax leakage results in the most amount of return generated for the client. And the second is liquidity. So a 10 crore person is not a 10 crore person if he can use just 10 lakh rupees out of that, right? So we have to make sure that wherever he's investing, he's also liquid at all times so that he can meet all the short-term obligations as in when they arrive. Now, while tax is a hurdle race, every year you have to minimize tax and you have to pay tax whatever is coming your way. The transferability is the most important part of wealth management. What do we mean when we say transferability? So whenever a person is going to leave the world, which is a certain thing to happen, the assets that he owns, the wealth that he has, should be easily migrable to the next generation, right? So while taxation is a hurdle, this is a game of kabaddi, right? There's no turning back, right? Once you hit the roadblock, you have hit the roadblock. So transferability should at all time be very imperative whenever you are judging any investment horizon. So risk, return, cost, tax, liquidity, and transferability. These factors are the holy grails that one should be looking at. Now that we have understood all the parameters that one should be looking at, let's discuss a little as to what actually is the horizon available for an HNI or for anyone to invest, right? Now, this slide is a little data heavy. I'll not go into details of the slide, but I'll touch upon a few basic things. So, for example, if you see, returns are very, variable in different asset classes. So, as real estate as an asset class, equity as an asset class, debt as an asset class, commodities and so on as an asset class have different return expectations, right? So, whenever the client walks into your door and he is expecting a certain degree of return, you have to have in your mind as to what return these asset classes have given in the past, right? The second is risk. So the client won't be aware of the risk. He might be, or he might have a slight, expectation of what might come to his way, but we have to be very clear as to what risk he's signing up for. So we have to analyze all these asset classes again on the risk parameters. Third is the entry barrier. We have to be very clear as to what is the entry barrier. So if the entry barrier is high, the hits that the client will take will also be high. So what do I mean? If suppose in real estate as an asset class, one has to have a lot of money before they think about investing in real estate, right? So if suppose 50% of their money has gone into real estate and that particular real estate was to get stuck in the next coming 2 to 3 or 4 or 5 years, 50% of his net worth is jeopardized, right? So we have to understand risk at that entry barrier risk level is also very important to understand, right? Third is taxation. We have to understand how complex or how easy the taxation on that particular asset class is, and according to that, we have to be, prepared as to how we are going to act as a fiduciary. Last is liquidity and transferability, right? So, for example, real estate is very complex and slow when it comes to transferability. Debt is very easily transferable, right? Equity is instant. One can transfer their assets to the other person using a demat account. This is the metrics which I have presented here. This is something that we have to have a holy grail of. Anyone has any question up until here? Yeah.
Suraj, we are hearing you.
Now, I do have a question. So, Mr. A is contemplating to park 70 lakh rupees to buy a car, right? Luxury car after 6 months while advising him the investment vehicles. What is the correct order of thinking, right?
Check.
So, if anyone would like to answer this in chat.
So our team is answering D. Hello. Suraj, are you able to hear us? I think wahan pe kuch.
Okay. So the right answer here is planning, strategizing, executing, and reporting. Again, so this has to be the holy grail, irrespective of whether the person is planning for retirement, for any aspirational goal, whatever be the time zone, whatever be the time horizon that they are investing for. This has to be the holy grail of how we have to move. Now,
Yeah, thank you, Suraj.
Tejwani ji, we are not able to hear you.
Yeah, thank you, Suraj. So now he has laid down the complete framework as to what are the three balances we always have to remember, not for just ourselves, even for the client advisory, that what are the returns which we can expect, what are the risks which are associated with each investment class that we have, and whether it is easily transferable or not. And to work on each class now, I'll be asking Suraj to take us through the guardrails under equity first. And again, just one more thing before he starts, that he will also be giving us few scenarios and a few options which are to be kept in mind while deciding on the guardrails. Yeah. And it is our own judgment, more research before we take advice for ourselves or for our clients. Okay. So Suraj, back to you.
Thank you so much, sir. Thank you so much, sir. Now, equity allocation metrics. So, as rightly pointed out by sir, and sorry, as I missed that, it's not an advisory, right? It is an educational session that you have. It every time you for yourself or for the client are trying to advise anything, please be very cautious and very sure before you go on to advise anything, right? Now, equity allocation matrix. Now, there's a rule which I'll give you, which is not present here on the screen. Every time someone is investing into equity, no, this is my own personal belief that return should be the last parameter that you should be looking at, right? Whenever someone is investing in debt, I mean, I'm okay with someone looking at the returns first. But when you're looking at investing into equity as an asset class, the rule of thumb should always be to first analyze all the risk parameters and then see what is the most suitable as per your risk appetite, and then go for the returns that are available in the different asset class, right? So I'll take up some of the examples here. So for example, if you see returns in equity are, you can expect anything about 10%, right? In the equity as an asset class in total, right? So different asset classes give you different kind of returns. For example, if I give you a simple example, that Nifty in last 25 years has given a 13.5% average return, right, per annum compounded. So what does that mean is that any asset class, if you see, it has a range which is around 13.5%. Now, what becomes imperative is to understand what is the risk, right? So for example, mutual fund ETFs, these are low to high risk when compared to other horizons. Why do I say they're low risk? Because of the fact that they're heavily regulated and they're very liquid. A lot of participants are there, and it is heavily regulated by the regulators, right? Second on the risk parameter is PMS. Again, the kind of regulatory oversight which is there on PMS is also very high. The others I'm going to take up later in the presentation. Entry barrier. Again, this is a very important factor that one should be considering. The moment you put in some money, that money is always at risk, right? So if the entry barrier is high, it has to be avoided for someone who does not have that kind of risk appetite. So PMS has a 50 lakhs entry barrier. So if someone wants to invest into a PMS, portfolio management service, he has to have a minimum of 50 lakhs investable, right? For AIF, it is 1 crore. And for SIF, which is a special scheme, which I'll be discussing, it is 10 lakhs, right? So mutual funds as an asset class, one can start with as low as 100 rupees. ETFs, again, one unit, which is roughly ranging from 100 to 500 rupees, right? And PMS 50 lakhs, AIF 1 crore, SIFs 10 lakhs, right? Now, the cost of investing into mutual funds and ETFs is always the lowest. Why do I say so? Because it is meant for the masses, right? It is meant for the masses, and regulators have this regulation that you cannot charge more than this, right? So the total expense ratio, the cost in mutual funds and ETFs is the least. In PMSs, it could be at as high as 2.5%, plus there could be a profit share. And in SIFs, it could be as high as 2.5%, right? Liquidity. Now, liquidity is the most liquid instrument of all are ETFs, which are liquid on the day of sale, right? Mutual funds are 1 to 3 days liquid. PMSs often come with a lock-in. Lock-in means that you cannot withdraw the money for certain amount of time. Once that lock-in is passed, PMS and AIFs also become very liquid, right? Now the matrix winners. Now what I have done, I have classified into two parts, right? So for everyone, for yourself and for your clients. And for the people who get in touch with you, you can easily say that ETFs and mutual funds are available to invest for everyone. Why? Because they're highly liquid. You can buy them for as low as 100 rupees, and they kind of marry the return that is there in the equity as an asset class, the broader index, right? PMSs are a HNI winner because of the fact that they give you better returns compared to mutual fund and ETF. Of course, they come with a risk, but they have an entry barrier of 50 lakhs. So one who cannot afford to, put 50 lakh rupees in one basket is not the proper audience for PMS. Now, again, PMS, I've again written down what are the benefits and downsides of investing into PMS. The benefits are, again, high alpha and direct demat holding. You have a lot of visibility as to what is happening in your PMS account, right? The only two downsides that we have is the fact that all the things are held in your own demat account. So it is not like you have cut a check for an advisor and then, like in the case of mutual funds, whenever you will be selling the mutual fund unit, the tax incidence will come to you. Here, the tax incidence starts to happen the day your advisor decides to sell off a unit in your demat account, right? The brokerage, STT, short-term, long-term capital gains, advanced tax liability, everything comes to your own PAN on day one. Second is the POA risk, and this is something which people are not very aware of and people do not pay a lot of attention to, but it is very, very important. What does this POA risk basically mean? Every time you enter or your client enters into a PMS contract, they are in a wrapper agreeing that whatever the advisor wants to do in his demat account is his own liability, is the client's liability, right? So let's take an example of someone who's, say, a senior management, employee with Reliance Industries Limited, right? And he enters into a PMS contract with some broker. Now, if the broker happens to buy the shares of Reliance Industries Limited, and there's a legal guardrail that he cannot invest, say, certain number of shares in Reliance Industries Limited, he himself becomes liable for that non-compliance. He cannot say that my investments were being done through a wrapper and I don't know what's happening, right? So this is something that you, every time a client comes to you, you also should have a oversight upon. Any question? Now, taxation of PMS, as I told you, it is a pass-through status. Everything that happens, right, in your demat account is your own liability. So even the tax incidence, if it happens in your demat account, it is upon you to pay, right? So you have, the client or the person investing in PMSs have to be very sure that the tax incidence won't come when he'll be exiting the PMS. The tax incidence is going to come on every day there's a trigger in the demat account, right? So short-term, long-term capital gains will happen on the day of these things happening, and quarterly advanced tax estimation has to be made in a more complex fashion, right? So we as professionals have to be very, hand in glove with the client as to what is happening in their PMS. Now, SIF. As I told you, mutual funds is available for the broader mass to invest, right? And PMS is something that one can invest only after they have 50 lakhs in their pocket. So there's a midway bridging gap that was required to be filled, right? That's where the SIFs came into picture. These are specialized investment funds. I'll not go into the technicals of what is allowed, what is not allowed to be done inside, but I'll just give you a little understanding of who this is for and what does it actually do, right? So this is for someone who can shell off 10 lakh rupees from his pocket for investing and who wants a better risk-adjusted returns than mutual funds, right? So these have a better risk profile than that of a mutual fund and have a better return, generation capacity. Correct? Now, again, now that we have discussed a lot about equities, and you must be, very enthralled to go and start an SIP as soon as possible, right? let's also understand what is the rule that we need to understand before we start to do this, right? So the first rule, which should be there in your mind when you are planning around your wealth or your client's wealth, is the target net worth rule. This rule simply says that what should be your net worth at any given point in time, right? So this acts as a personal benchmark of whether you are going in the right fashion or not. So how does this work? You have to take your salary, right? Whatever your gross income is, right? Multiply that with your age and divide it by 10, right? So if your age is 30, you're making 10 lakh rupees a year. You should have a 30 lakh rupees net worth at that point in time, correct? Why is this rule very important and why does this rule matters? Is the fact that this rules kind of rules out your earning capacity. This says, hey, I don't care how much you can make, right? I want to see that if you stop making that money on any particular day, are you safe enough to sail, right? So this rule encourages you to be a little, on the saving side of the equation, start accumulating your wealth as and when you are growing in your life, right? So this rule kind of shifts your focus from earning ability and brings your focus back to asset accumulation at all times in your life. Correct? The second rule, now there's a question around this as well. So Mr. Rahul, he has inherited some 40 lakh rupees from his grandfather, and he wants to invest into one of the equity vehicles. What are the equity vehicles that he can invest into, which is not investable for him? Right. So first is equity mutual fund, second is SIF, third is PMS, and last is direct equity. PMS. Right. So the answer to it would be PMS, right? Because the PMSs have an entry barrier of 50 lakh rupees, Mr. Rahul cannot invest into PMS. All the other avenues are available for him. Now, how can your client or you invest into ETFs and mutual funds? First is account setup. It's very simple. You can go to any Demat account, broker, open your Demat account and start investing after the KYC is done. The only thing which you need to take care of is that the broker has to be a low-cost broker. There are brokers which have zero, brokerage for investing into mutual funds, to a broker who can charge as high as 100 rupees or 200 rupees for every transaction, right? So you should first see that the broker is low-cost broker, and second, the broker sells you a direct plan, right? So there's a direct plan and a regular plan. By nature, direct plan happens to be a cost-effective way of investing, and regular funds happen to be a more costly way of investing. So you should be investing in a direct plan, right? Now, again, whenever the client or you yourself are investing, you should always see that you are making the portfolio construction properly. How to invest into PMS? PMS investing is also very simple. The only entry barrier is the 50 lakh rupees that you have to have, right? If someone is ready to invest into PMS, they can very well invest, and it's pretty much the same. Whoever is selling or the distributor of the PMS takes your credentials, create a Demat account, and then they go on to do it for you. Right? The only thing that we can, every time the client comes to us, is that we check the rolling returns of PMS and not a point-to-point returns, because most of the times clients say कि पिछले एक साल में इतना return आया and I want to invest into this instrument, but we should be seeing that वो particular instrument ने over a long duration of time in a rolling return basis कितना return दिया versus whatever the benchmark was, right? The one more thing that we need to be very cautious of is that the fee structure should be right? So PMSs have this, because I told you कि PMS के case में the fund manager himself can decide what will be the fee. So there are two models of charging fee from a client. The client can pay a fixed fee, or there could be a profit share, right? We should always try that the client is going for a profit share mechanism, because that will better align the goal of client with the fund manager, right? The fund manager would be inclined to grow his wealth more and more so that they can make more and more money. Correct? And we should also be very cautious of the POA risk. We should check whether the PMS is discretionary or non-discretionary in nature. Now, every time an advisor comes to your client for equity investment, this is very important. These are the basic parameters that you should always check, right? That whoever is walking through the door of the client is a SEBI registered person. He is not someone who is, coming as an advisor or packaging himself as anything else. Second, there's a proper disclosure of how much money they are going to make from the client, right? Third, there has to be a suitability documentation done. The client and the advisor should agree that what are the risks that they want to take, so that because PMSs and AIFs happen to be an internal strategy, right? There's no guarding rail such as which is available in case of mutual fund. So the person should be very comfortable as to there's a suitability documentation made that what risk he wants to take on day one, right? And professional liability, again, we should also be seeing that we are not representing ourselves as a investment advisor of the client. So there's a question again on this one, that ABC LLP is a firm of chartered accountants. Mr. M is a super senior citizen. He has entrusted ABC LLP for his income tax filing and GST work. Recently, an employee of the firm has advised Mr. M to invest into a PMS where he happens to lose some money. What will be the repercussions of the action by the employee, right? So, A, there would be no liability on anyone because Mr. M has invested on his own. B, there would be liability on ABC LLP because ABC LLP did not maintain enough internal controls, to desist such employee upon, advising to any client, or there would be just an, action on the employee. The answer is that that both the firm and the employee could be under radar.
Yeah. Thank you, Suraj, for taking us through this. And what I have understood, and I think, again, I give an example. One, very recently, HDFC Asset Management, they visited our office to give the presentation. And they ensured that everybody, even the article students, they are doing the SIP of 100 rupees or 200 rupees. So that was the start for everyone. Of course, my personal preference is also ETF, always ETF, because it is more market linked. And the best part is that you can just hold one ETF or one 100 rupee SIP. And this, I guess, even if we are earning less, we could do it. And PMS, again, is very exciting. But earlier, when the limit was 25 lakhs, I was invested. And I actually got a decent return of around 12%. But of late, it has gone to 50 lakhs. So let's see how best. But again, it has a period of 2 to 3 years, which is lock-in. But yeah, in a long term, but the only challenge which I found in PMS, which he also rightly pointed, was the POA. We just sign it that, okay, you do whatever you want to do. So that created, while filing my annual tax return, that, oh, there have been number of transactions which have either given me short-term gain or a loss, or long-term gain or a loss, which was not considered while calculating my advanced tax liabilities. So that one aspect we have to be extremely careful of, but otherwise advising to the clients for HNIs, PMS could be a good option. And SIF, which is very, very new. In fact, it was very recently effective April 1, 2025. This was introduced by SEBI. And we are still exploring. In fact, even very few advisors are authorized to carry out SIF. But again, it could be a good ongoing investment with 10 lakhs. And rule that you gave was again good, very interesting, that multiply your annual earnings with age. Age में से अगर आप 40 साल के zero हटा दो, 4 into your annual earnings. So if your annual earning is say 20 lakhs, so 20 lakhs into 4. That is, we should have at least 2 crore ka the net worth as at the time of 40. So very exciting. And now, Suraj, let's explore the debt allocation guardrails because equity was all about growth. Let's understand what the debt could give us, how it could help us to balance our portfolio for all of us. Also, how best we can advise our senior citizen clients, how best we can advise the girl child in every family up to 10 years of age. What are the mutual funds which which deal with the debt funds? And as you pointed out in one of your earlier slides, as per the published data, even debt funds have given us slightly better return than FDRs. So while equity is for growth, very exciting for young people, where the returns are not to be seen, in debts, returns are to be checked, of course, with the fixed return bonds and the FDRs available. Of course, debts, as I understand it in my own experience, are very, very safe. But then for senior citizens and the girls, what are the other options? So, Suraj, if you could take us through the debt.
I think Suraj is required to rejoin. Jay Kumar ji. बस नहीं क्या ठीक हो गया Suraj is required to rejoin.
So we are experiencing our own sweet time, but I'm sure next time will be much better. Yeah. So over to you, Suraj, to take us through the debt grill.
No. Hello. Yeah. Yes, Suraj. Now you can start. Voice नहीं आ रहा.
Yeah.
We are not. Yes.
So let's discuss the debt allocation guardrails that we have, right? Now, before we begin, there's a rule again which we need to understand. So, why is this rule important? So, I'll first take you to the rule. The rule says that 100 minus age should be how much you should be investing in equity, right? So, if your current age is 100, right, 70% of your money can go into equity and the remaining should go to debt. Now, because this rule exists, right, it becomes very important to understand debt as an asset class and how to invest in debt as an asset class to get the maximum return and keep compounding our wealth. Now, when we look at the debt as an asset class, these are the different classes which are available. Of course, there are many more, but just to give you a gist of it, bonds, bank FDs, corporate FDs, mutual funds, arbitrage funds, PPF, Sukanya Samriddhi account scheme, which is for girl child, as sir pointed out. Some schemes specifically for the senior citizens, and some annuities are the investment horizon. Now, the returns in debt can be as low as 4% to as high as.
Suraj, the
Able
not
to,
visible.
uh,
Slides are not.
hear you. Suraj, your presentation is not visible.
यहाँ पे
You need to unmute yourself, Suraj. Suraj, you need to unmute yourself. Tejwani ji. Yes.
So in case of debt, the returns vary from 4% and can go as high as 8.59%. So in case of debt, the day you subscribe for a debt instrument, you know how much return to expect, right? So it is just in contrast to what equity does. So equity, you have to have a return expectation, right? And then you have to assess the risk, and basis that is what you are going to invest. Whereas in case of debt, you know at day one what you are signing up for. And if you invest into a debt, which is a low yielding debt, you are going to be married to that rate of return for the rest of your tenure, right? So in case of debt, we have to be very cautious as to what is the return. And then again, in case of debt, there is some degree of risk, but it is not as stark as it is in the case of a equity instrument, right? So for example, some of the debts come with a sovereign guarantee. Some of the debt come with the structural guarantees, right, such as 5 lakh rupees. And then there are debt which are naked and come with the market risk, which in case of debt is a interest rate risk, right? Taxation in case of debt is more or less now on the slab rate only. There is some exception to debt mutual funds. We'll be covering later in the slides. And liquidity, again, it could range from highly liquid to highly illiquid, right? For example, if you invest into Sukanya Samriddhi account scheme, right, it becomes illiquid the day you invest into it, right? It will only be withdrawable after the completion of 18 years of age of the girl child, or at the age of 21 of the girl child, right? Before that, it is highly illiquid, right? So again, when investing in equity, we have to see the parameters, and basis that we have to pick which return we want to choose. In case of debt, we have to be very cautious as to what we are signing up for, because the day you sign up for a debt instrument, you lock in yourself both in terms of liquidity and in terms of return expectation that you can have. Now, in debt allocation metrics, the top winners which we want to highlight here are first the provident fund, right? Voluntary employee and public provident funds. These kind of come with the tax shield itself, and or are also zero risk in the sense that they are backed by the sovereign guarantee by the government of India. Second are the tax-free yield funds, which are specific purpose funds, for example, Sukanya Samriddhi account scheme and senior citizen account scheme. And the last in this category would be tax efficient funds, right? Which is arbitrage fund. Anything other than these can be something that you can avoid in your portfolio, right? Now, first, like sir said, like sir said, he started investing into PF right in his student days. Everyone should be investing some amount of money into PF, because into PPF, specifically because this comes with a sovereign guarantee, and it kind of creates a vehicle for you which is alien from you, right? So if there's any legal or any roadblock which comes to you, your PPF would never be touched by that, right? So that is something that you can sleep upon for the rest of your life, right? So one should be investing into PPF. Again, there's one more rule here. which says every time you get a bump in your income, 50% of that bump should be going into investments, right? So why do I keep this rule here? Now we have understood equity as an asset class. We have understood debt as an asset class. What are the parameters that one should be looking at? So suppose you are at a salary of X and your salary increases by 10%, at least 5% of that increase should be going straight towards investing. It could go to equity, it could go to debt. What does it do? Again, it neutralizes the lifestyle creep, right? Because every time your income is increasing, you're not going to enjoy the whole of it at one go, right? You get a bonus, you get some gifts from someone. Any amount that comes to you, 50% of it should be going towards investment. In the 50% you can very well enjoy for your life. So the instrument again, we are coming back to the instruments. Sukanya Samriddhi account scheme, I'll tell you a little about it. So this simply says that everyone who has a girl child, up to 2 girl child, can invest up to 1.5 lakhs per annum into a Sukanya Samriddhi account scheme. Now, as the name suggests, this is meant for the welfare of that child when the child matures, right? So this scheme comes with a lock-in where you cannot withdraw the proceeds before the child attains the age of 21. At the age of 18, you can withdraw 50% of that corpus, but that should be going for the higher education, right? So the rule is lock-in is 21 years, right? But you can withdraw 50% of the amount when she turns 18, and that has to go for the higher education, right? You have to present the proof that it is going for the higher education. Right? And this is a very good scheme. Any parents having a girl child should always be having this scheme in their portfolio. Now, arbitrage funds. Lately, people have not been lot educated about arbitrage funds. People are stuck with a lot of FDs in their portfolios. There's a clear shift that people can make from FDs to arbitrage fund. Why do I say so? Because of the fact that arbitrage funds are very market neutral and are very low risk. So what they basically do, they exploit the price mismatch, right? I'll not get into the technicalities of it, but they virtually carry zero directional risk of the stock market. There could be some days on which these funds can show negative value, but barring those days, they have a very straight line kind of curve in the return. Second fact, that they are treated as an equity for the income tax purposes, right? By nature, they are debt-like, but for income tax spectacle, they are always treated as an equity instrument. So what do you get as a benefit, right? So if you park a large chunk of your money into FDs and you are earning interest on that FD, every year, whatever the accrual is, you are going to pay tax on that, right? But in case of arbitrage fund, your money keeps on compounding at the same, more or less same rate of return, what FD does, but you are not paying tax every year. Point number one, you are paying tax only when you are taking money out of arbitrage fund. Two, that when you are redeeming arbitrage mutual fund units, right, you are redeeming capital plus return, right? So you're getting money out of capital, right? Some portion of the money out of capital as well. So the tax impact is again less on that amount that you are withdrawing. Third benefit is that if you are withdrawing it in a long-term capital gain kind of situation, the tax implication itself is 12.5%, right? So for example, so for an FD, you would be having paying 30% per annum irrespective, right? Whether you churn it or not. In arbitrage funds, you are paying 12.5% and only on the day when you are redeeming the units. Also, you are taking out some capital, so a portion of withdrawal would be taxable, right? And these are very liquid, right? They come to your account on T+2 days. The second benefit, the one more benefit which you get here is that there's no penalty on withdrawal, right? So if you're withdrawing from arbitrage funds after 30 days, typically 30 days is the guardrail there. After 30 days, if you withdraw anything from arbitrage fund, there's no penal deduction on your withdrawals. In case of FD, if you are withdrawing money from FD within a year, there could be 1% deduction from the interest that you have from the principal or the interest that you have made, right? So these are the technicalities that one should keep in mind before making their mind up between arbitrage funds and FDs. This now senior citizen account scheme. This again is a very good, top tier investment horizon. But the only factor is that you have to be a senior citizen to be investing into it. The other downside is that you can not place more than 30 lakh rupees into senior citizen account scheme. So if there's a senior citizen client of yours who has say 1 CR, 30 lakhs can go easily to senior citizen account scheme, and then they can put say another 70 lakh rupees into arbitrage or FDs or whatever. Correct? Now, the interest that you get on here is taxable, right? So whatever interest the person gets, so the moment he's investing into senior citizen account scheme, he gets a deduction under erstwhile section 80C, now which is section 123 of the new act. But the moment he's earning the interest, that interest becomes taxable, right? And there's also TDS applicability if the income is upwards of 50,000 rupees in a year. Now, because we are discussing debt as an asset class and we are tax professionals, so it becomes imperative that I touch upon the recent change which was brought in the debt mutual fund taxation. So it simply says after 1st of April 2023, everything that is earned in a debt form will be taxed at your slab rate. Simple, right? But for the units which were bought before 1st of April 2023 and sold after 23rd of July 2024, we have to check for LTCG, STCG, right? Now there could be LTCG, but the indexation benefit is not there. Correct? Again, I've taken a question here that if Mr. M is a super senior citizen, he has 30 lakh rupees investable, where should be he parking his money if he wants to put it in debt category? So senior citizen account scheme, arbitrage fund, corporate FD, where should he be putting the money? Ideally, he should be putting his money into senior citizen account scheme because the corpus is 30 lakh rupees and he can get 8.2% return on this scheme. Now, we have understood equity, we have understood debt as an asset class. We have also understood what should be the net worth that we should be aiming at. Now, what should be the rate of return at which you should be growing, right? So people generally have this perception कि यार 10% return आया, so it's very low, right? 5% return आया, very low. 20% क्या ही होता है, right? So just to give you a visible understanding of how money actually works in compounding, there's a rule called rule of 72, right? So if you divide 72 by any rate of return, that is the amount of time you need to double your money, right? Or if you have an investment horizon, suppose you say that I want to double my money in 4 years. So you will divide 72 by 4. That is the return that you should be aiming, correct? So at 12% CAGR, if you were to grow your wealth at 12% compounded, 6 years is the time frame you will require to double your wealth, right? And if the inflation applicable to you is say 6%, in 12 years time, your purchasing power becomes half, right? Now, what does this rule ensure is that when you have already seen the rule of 100 minus age, right? That how much money should be going into equity, how much money should be going to debt. This rule ensures that at the early compounding stage of your life, you are not putting a lot of money into low yielding products, right? So you have a target of doubling your wealth every 6 years, right? So for example, if you grow your wealth at 12%, in 6 years, 1 crore becomes 2 crore. In 12 years, it becomes 4 crore, right? And at 18 years, it becomes 8 crores, right? So if that is the holy grail that you are aiming for, you can again tweak how much you want to put in which asset class.
Yeah.
Yeah, I think very nicely covered. The just reshare. So something very interesting, at least I have picked up, apart from PPF. PPF, of course, gives us the tax-free return of 7.10%. So I recommend to almost everyone who is adult to have the PPF account if already not open. 1,50,000 is the annual contribution that can be made. And two very interesting things. One is the Sukanya Smriti Yojana, giving us 8.2% with almost a lock-in period of 21 years. Again, sounds very, very interesting. So I just give my own example. When Gunjan was born, there was a scheme called Raj Lakshmi scheme by UTI, and they guaranteed a return of almost 12%. And I remember that again, it was a 10-year scheme. I contributed, and it really gave us a wonderful return, of 12%. At that time, the rates were very high. So similar, I could match with Smriti, Sukanya Smriti Yojana. Another very interesting scheme, which is good for advice and even for us aging up to the senior citizen of 60 years, could be the senior citizen bonds, giving us 8.20% return. And though it is taxable, but maybe at a certain age in time, we could still be benefited out of the returns that it is generating. And one thing which is very, very important for all of us, whatever age group we are in, that while equity is growth oriented, youth in the maybe the age group up to say 35 or 40 could really be more aggressive in terms of their investment in equity oriented funds. But once we are at a certain age with a young family, maybe we can get into the debt funds. Commodities cover करिए कुछ और cover करेंगे थोड़ा बहुत इसको. Okay. So this is how the balancing should happen. And now I'm going to give it to Suraj again, that commodities and leverages in particular, how best as a concept we understand and take it forward with our future asset class. And this again is very, very exciting because very lately, in fact, we started investing a small portion in commodities. So, Suraj, if you could take us through commodities, and this is not visible to us yet. Your slides are not visible. And as we are already 1 hour 40 minutes, quite significant time wasted on our, the systems, but we'll be trying to cover it up in next half an hour maximum. So, Suraj, if you could make your slides visible or share your slides. And after commodities, we are going to discuss very interesting offshore investing, which I'll be taking up along with Suraj. Why do we share?
Suraj, can you share the presentation? Yes.
Yeah, he's just sharing the presentation.
presentation.
Yes, yes.
And later I'll also
And
talk
later I'll
about the
also talk
FATCA
about
and the
the fact and the
CRS.
CRS.
I have forwarded to the
Yeah, अगली बार ध्यान रखना के बाद
वही सो रहा हूँ ट्रेन से।
हाँ कुछ तो इसी
Is it okay if we share the PPT with you and maybe you can run and then Suraj
Yes,
can
yes,
continue?
that is okay, sir. We can do that.
Because I think we are facing some problem. So
You
Suraj is
share it
just
on, you share it on hr@kalanico.com.
HR at, okay. So he has already shared it. If you could please run from there.
अच्छा ठीक है.
HR. अब इसको छोड़ के ऑफशोर पे आए, ये कमोडिटीज लेवरेज पे में बात करना चाहेंगे।
सर ऑप्शन क्या है?
आप वो share करो presentation. So we need to share it from commodities, right?
We can share it from offshore now.
Offshore, okay. Slide number? एक बार आप देख लो.
It is immediately after commodities.
Okay. अरे तुम शेयर करो ना. एक पीपीटी भी शेयर करो. चलो आगे. डायरेक्ट चल Yes, yes.
So while we set up the
Come back.
offshore, it is very important now for us to understand that now we are moving from the domestic to global, an area which is very, very close to our practice in JKT Co. And this again is now very important for all of us to understand that apart from India, we have the global market as well for us. So let's start with the offshore investing, within which I'll also be talking about the FATCA and the common reporting standards, which even ICAI has given us the guidance note.
ये शेयर नहीं हो रहा है.
आप उसको डाउनलोड करके शेयर करेंगे तो इजी रहेगा. If you could just download and yeah, offshore investing, yeah. So
Yes,
Suraj will start and I'll also be participating in this. Yeah.
Yes, sir. Now we can start.
Correct. Yes. So the first slide is visible to me. If you could, yeah.
Offshore. आगे इसके बाद जब आएगा बस नहीं ऑफशोर
Offshore
Yes.
investing again is a very important thing to touch upon. Most of the times when clients happen to have a cross-border relationship, right? They either are employed elsewhere or become non-resident due to any reason. Offshore investing also becomes very important for us as a practitioner, because for client and at the end of the day, returns is the only thing that matter. But for us, compliance is something which we have to always take care of. So if we go to the next slide, we'll see that how one actually participates in the offshore asset class, right? So the first way is to send money out of India, start investing out of India, right? While doing that, we have to be careful of what LRS rules are. And the other way of investing into offshore, horizons is through a international financial service center, correct? So if we go on to the next slide, yeah. So what are the LRS rules and what are the TCS applicable on LRS? So I'll not take a whole, heavy duty class on this. Simply, whenever your client is sending money out of India, there are two things that we need to be cautious about. One, that at any given point in time, this is a cumulative limit for the whole year. In every financial year, every resident individual is allowed to send only 2.5 lakh rupees, lakh US dollar under the LRS scheme, right? So this is applicable to every individual irrespective of age. So even in case of minor, one can send 2.5 lakh dollars, right? Now, when they're sending 2.5 lakh dollar, there could be different use case for which they could be sending it, right? So they could be sending for investment, they could be sending for tourism, they could be sending for education. So there are also TCS applicability on the end use of the money, right? So LRS tells you how much money you can actually send, but the TCS norms tells you how much money would become liable to TCS basis the use case, right? So what are the rules here? Earlier, the limit was 7 lakh rupees. If 7 lakh rupees was being transferred out of India, there was TCS applicability. Now that has been, the bar has been raised to 10 lakh rupees. So per financial year, 10 lakh rupees is the threshold that we have to check for TCS. After that, we have to also check what is the purpose for which the money is being remitted, right? So for educational and medical remittances, the TCS earlier was 5%, has now been brought down to 2%. But in education as well, if it is eligible education loan, which was erstwhile Section 80E eligible loan, there is no TCS which is applicable, correct? Now, for overseas tour packages, it is 2%, right? The TCS is 2%. Now, what is special about this is there's no minimum threshold, right? So if the amount was even below 10 lakh rupees, we have to check for TCS, right? For any other remittances, there could be any other reason for remittance, it would be 20%. Okay, so these are the things that we need to keep in mind. Now, whenever the client is doing any LRS investment, they also assume, yeah. Okay, so let's come to what GIFT City or IFSC actually is. So GIFT City or IFSC in the simplest form of terms is an Indian, geographically Indian entity which acts as a foreign entity for investing into offshore products, right? So these come under category 1 AIF in GIFT City, right? Other is the feeder fund access. So what do we mean by feeder fund access? As the name suggests, it is a Indian regulated wrapper. Like for example, if you were to invest in a mutual fund in India, what it will do, it will invest into equities of Indian, companies in a mutual fund manner, right? So the same way, GIFT City feeder fund gives you access to the global equities and also the private markets in the global landscape in a LRS compliant fashion, right? ATA, LA tax holiday is applicable to again the IFSC working there, not so much relevant for the individual investor. One thing which becomes very important for us to understand and to educate to the client is that transaction tax cost, right? So the security transaction tax and commodity transaction tax is not there in case of investment through an IFSC, right? Which is GIFT City in India, right? And the fees also that they paid to the manager are also exempt from GST. Correct? And for a non-resident, there is no LTCG or STCG on these investments. I would like to call upon Jay sir if he wants to add anything upon this, right? Because when it comes to taxation, I'm always counting upon him.
Yeah, I think this is again very exciting about the Gift City because a lot of us are not aware whether the investments can be made through the Gift Cities and particularly for non-residents because they seek a lot of advice on it. So non-residents can be advised that they can, through the fund managers, which are very few and regulated, the investment could be made. And the best part for them, like FCNR account, is that whatever returns they get in the form of dividend or even capital gains in number of cases is not taxable. And even for residents, the investment is allowed, but they would be subjected to the, in case there's a short-term capital gain at the slab rate or 30% as the case may be. But we must explore the investment through Gift City. And second, as you rightly pointed out, there is no GST, no STD kind of thing on, or the CTD on the transactions that we do through the Gift City. And there are options which are opening up. And as and when in some, you find an option or the time, explore the beautiful, the Gujarat International Financial Tax City. It has come up so well. It's a city in itself, and with all these benefits, one can really get a lot of tax as well as the return benefit. We can move to the next slide now.
So
Now, as far as reporting, as far as the reporting requirements are concerned, I'll just be coming back to this slide in a while. Let's go to the FETCA and CRS first, which is, I guess, the next slide. And we'll come back to this slide shortly. So please take us to the next slide, which is FETCA and the CRS. और थोड़ा आगे जाइए. एक और आगे जाइए.
Yes.
Yeah. So what is FETCA? What is CRS? Why this is so important for us who are practicing the international law. What is FETCA? Let's understand FETCA. So the full form of FETCA is the Foreign Account Tax Compliance Act. Foreign Account Tax Compliance Act, which is a US regulation enacted in the year of 2010 by them. And the purpose was, the aim of US was to ensure that the green card holders or the citizens of US, regardless of their residence, wherever they are around the world, they should report their investments abroad. So as an example, if a citizen of US, and okay, one more thing, that their citizenship continues even if you exit US for next 10 years. Unless, and if you have been a green card holder 10 years, even if you have surrendered or you are no more the residents. So FETCA is a foreign tax account compliance. So if somebody is in India, the Indian institutions, including the bank, they have to report whether a person has been or is a US citizen or a green card holder or was a US citizen, and what are their investments in India, including the mutual fund investments, any bond, insurances, fixed deposits. They are to be reported by those institutes to the US domestic law authorities. And I'm sure we all would have faced it, that there is a FATCA form, which banks very often, in fact, almost every year, they get us, they ask the clients to fill up whether we are US citizens. And if yes, the FATCA form is to be filled up. So in case it is not done, there is a 30% tax impact on for non-compliance, 30% tax impact of the gross value, which is available or which is actually the investment in the foreign account, and which is a significant account. And FATCA, whatever assets are declared in FATCA, they also become part of the FA, foreign asset disclosure, that we do in the income tax return. And at JKT Co, we have number of such clients where FA is important, FATCA becomes critical, and these reportings are made by us. And US person, as we must know, is the green card holders, regardless of their residence, anybody who has or is the citizen of US, again, irrespective of number of days that they are present. So this is about FATCA. Similarly, the ICAI has come out with a wonderful guidance note that we were going through on the common reporting system or the common reporting standard, which again is a global standard. It is based on the OECD G20 standard, which was launched in the year of 2014. And it is nobody's law. India doesn't have a law on this. We are all following the 2014 multilateral standard. And almost 110 jurisdictions, including India, they have signed this common reporting system. So what is CRS? So CRS is about, as we can note from this thing, that it is more about the tax residency, where an individual who is legally residing and pays income tax, they have to report the assets that they are holding, not just in their own country, but assets which they are holding abroad. Because FATCA is more related to US, but common reporting system is about other assets as well, other than US, including US, if FATCA is not done. And it is more dependent on your tax residency, where the individual is currently and legally residing and pays the income tax. And the mechanism here is that it enables the automatic exchange of data between the national tax authorities. And as an example, again, we find a lot of notices being issued that, oh, you have assets in Australia to this extent, which you have not reported. And it is all through the common reporting standards, which are followed by the institutes, the banks, and various authorities who are holding the investments by the individuals or HUFs, etc., who have the foreign holding. So this is how the FATCA and CRS, they work. Maybe we can go to the next slide. So FATCA requires the personal and the tax details. And if you fall under it, the supporting documents are needed, like your current residence, and if you have been at any time the resident or citizen of US, the documentary evidences related to it. But the key important rules are that in case there is a non-compliance, if the form is issued to you by the bank and we do not fill it within the defined time period of, say, 30 days, the accounts are frozen. And the information that we file is shared with the IRS, that is the US tax department. Okay. So these are something very important, so we cannot ignore. Even if it is not applicable, say not applicable. Yeah, we can go to the next slide. The checklist, which Suraj will cover, and then I'll go back to DTAA. So checklist, Suraj, if you want to cover.
Yeah. So checklist is pretty simple, right? What we have to first, so it's very methodical, right? We have to first understand whether the person is resident or a non-resident in India, right? So for that, we already know the rules. 182 days, we have to check that first, because that's where the major taxation implication will start to trigger, right? Once that is done, we have to also, in addition to that, see that if the person is US resident or not, right? Because as sir rightly pointed out, US has its own way of getting things reported, right? So for example, FATCA, PFIC, all this come into picture if a person is US resident or if he has a citizenship of USA, correct? Once these two are done, we are pretty much closer to complying around the taxation as far as concerned. After that, we have to also see that if there's any remittances being made by anyone who is, say, India resident in India or not, irrespective, we have to also check for TCS and credit mechanism for that particular person. Because we are taking care of wealth management in this presentation. Every time someone is making any investment, we have to double check whether those investments are allowed as a deduction in the Income Tax Act, right?
Yeah. Yeah, very right. Very right, Suraj. So in short, in terms of advisory, what we just discussed, and of course, we are going to go back to DTAA before coming to the case studies. So in advisories, the simple is that if you are filing a tax return or filing a FATCA form or informing the overseas assets, or even during the course of assessment proceedings for the foreign nationals or NRIs, simple is check the residential status, check whether they have been holding or at any time were part of the citizenship of the US or any other country. All their investments along with the trail, they have to be recorded, copy of their passports, their uh, number of days spent abroad and in India. So all those things become part of the advisory while we are advising to a NR or NRI. And those documents may be required either for at the time of your filing, at the time of reporting to maybe the institutes, or even during the course of assessment proceedings. Okay, so this is what it is. And I request to just go back to DTAA. It is a previous slide. This is the last one, but उससे पहले एक DTAA आएगा. Yeah, और पीछे जाना है. Yeah.
Back. Yes.
Yeah, DTAA. Now, again, very, very interesting and important that India has DTAAs with now nearing 100 jurisdictions. So what are the basics of DTAA and how do we take the foreign tax credit? So in most of the DTAAs, the provision is that wherever the capital gain arises, so if Indian shares are sold, India will have the primary right of taxation, the first right of taxation, and they can tax it. And the other country where the person is, say, resident, suppose the person is resident of US, he has shares in India, sold the shares in India, India will tax it. But as he is resident of US, he can take the foreign credit because for him, India tax is a foreign credit. He can take the credit of it. So every DTA, while you are filing the tax return for a non-resident or advising or dealing with some kind of tax assessments, the reading of DTAA becomes extremely important because accordingly the relief can be granted. In quite number of DTAAs, including the erstwhile India, Mauritius, India, Singapore, where the capital gains, even of the Indian assets, were not taxable in India. They were taxable in the country of residence. So say somebody from Mauritius holding shares in Indian entity sells off the shares. So those shares will be taxable in Mauritius. And the similar case was in Singapore. So which means that there are exceptions which lies in DTAA. Of course, Mauritius no more because the GAR and the other provisions have now been made applicable, but DTAA reading becomes important. Okay. And second, if an Indian holding shares in, say, again, US, he sells off the shares. As per DTAA, the taxability happens in US. But he can always get that tax which is deducted there because his global income is taxable in India, through the foreign tax credit rules, erstwhile Form 67. He can fill up and get the claim. So this is how the DTAA and the foreign tax credits, they work together. Yeah, so this is the brief summary of the offshore where we talked about the options which are available through LRS and how the DTAA comes into picture, how best we can utilize it. And then very interesting and excitingly, we covered the gift cities, which I encourage everyone to go through it more. And then finally, we talked about the FATCA and the CRA. And there is now no loop left where the information is not exchanged. Therefore, if we are not reporting any foreign assets, there is every likelihood of getting challenged under FEMA, under any anti-money laundering, and under Income Tax Act. Yeah. So this is all about the offshore investments. So we can go to the final slide, which is number 7, which will be taken up by Suraj. The case studies.
Yeah. Thank you so much, sir. Taxation coming from you, it sounds like poetry. Let's see a few case studies. First is, suppose there's a client who comes to us and asks me that I want to claim the deductions under section 123, which was earlier section 80C. Where should I put my money, right? So if we were not, looking at the holistic picture, taking care of wealth domain as well, what we would suggest him that, sir, these are the different horizons where you can put your money. But now we have to also see that what investment can give him the most amount of return as well, right? So tax is taken care of because these are all eligible under the erstwhile section 80C, now 123. So if he invests his money in PPF, he invests his money in PPF, NPS, and ELSS, which all give the tax advantage to him. His wealth in 20 years will become 66 lakhs, 95 lakhs, and 1.29 CR under the 3 schemes. Yeah, while 66 is tax free, the other are pre-tax net worth that he'll be getting. Correct. So now every time a client comes to us, we can have a double, clicking upon what we tell him. Correct. Can we go to the next slide? Now, suppose there's a client of yours who comes to you and says, hey, I want to fund 50 lakh of education for my child who is say 6 years, 7 years old, and they want to, in 10, 12 years, they want to fund 50 lakh rupees education loan, right? Education goal, and they want to save up for that, right? Now, this side is very important. We have to keep, an understanding closer to our heart for our investment journey as well, right? So suppose these are the different, rate of returns that he can expect. Suppose he wants to park his money in FD, which is 4% post-tax. He has some debt-free investments where he can aim, say, 6% return. He wants to make a mix and match between debt and equity and wants to have a 10% return, and so on and so forth. These are the different returns that he can achieve. This is the amount of money that he has to save out every month to fund that 50 lakh education loan in 12 years, right? Now, if you go to the fifth particular, we see that percentage of money that he gets from the returns and not from the investments, from compounding is 18%, 26%, 44%, 55%, and 68%. Right. So at the end of the journey, out of the 50 lakhs that he'll be giving for the education goal, this is the percentage of money that he's getting from the returns, right, and not from the actual money that he saved. What is the recommendation for him, right? So the recommendation would not be based on this, but on the efficiency gain that he's getting, right? So efficiency gain is nothing but the difference between the compounding that he's getting and the difference between the return expectation that he has to have, right? So if you see the 4% post FD is not highly recommended. Why? Because just 18% is what he's getting from the compounding. 6% debt heavy is also a little recommendable. I think we went on to the next slide. Yeah. So going debt heavy can be recommended if he's, nearing retirement and he has a very low risk profile. What is highly recommended is to have a balanced approach where he can get a 10% kind of return, right? And at the same time, there's, a lot of chunk which is coming from compounding, right? So 10% return means 60 to 70% in equities and remaining in debt. So if you see, the higher we start to take the return bar, right? So from 10 to 13 and from 13 to 18, if we go, the efficiency gain starts to minimize, right? It is in line with, if you see, you want to go from point A to point B, which is say 100 kilometers away, right? And you start to pedal a little faster, right? For every speed gain that you gain after a point, the amount of time that you will be saving would be lesser and lesser, right? The incremental amount of time that you will be saving would be lesser. And same goes with the investing as well, that taking higher risk does not actually mean that you are going to make your path more efficient in a similar fashion, right? It won't be a straight line curve, right? So what we could recommend a client is that if he's very risk loving guy, he can go for as high as 13%, 12%. But on a conservative side, he should not go for FDs or something which gives him very low return of say 4% post tax, right? So this is another case study which gives us a kind of clarity as to how to structure a client's wealth. Now these are key references which you can all take a screenshot of and keep it handy with yourself, so that whenever you are planning something around your client's wealth, you can always go back and refer. Yeah. So again, this is again a snapshot of what all we have discussed.
Yes.
Thank you, everyone, for patiently listening to this presentation. If you have any questions, anything you want to ask, anything that comes to your mind, we are free to take up questions.
So, Tejwani ji and Suraj ji, I would just ask about this lifestyle inflation, which you discussed during the course of your discussion. So can you just elaborate on this?
Request Bhupendra sir to conclude the session.
Yeah. So basically, one thing one need to understand is, now I myself is explaining that what is this lifestyle inflation. So, when we were of your age, probably because of the less informed environment, we were having very less desires also, as well as, expectations also. And also, no iPhone, no any other gadgets, no multiple options to wear also, in clothes and all that. But at the same time, considering this, all marketing gimmick, I could say, everyone is now desiring more. If I was working with a small phone, rather there was no phone in our time. Now everybody have to have a phone, a smartphone, maybe ranging from 10,000 to rupees 1 lakh. So that phone is required by each one of us. Now, so far as clothes are concerned, we could, even wear the cloth of my elder brother when he was. So that was the culture which we had. But now, even you need lot of clothes, you need lot of shoes. ये सब चीजें आपको कहीं ना कहीं, and it is not with you only. It is with even we also. This lifestyle inflation is not affecting you. It is affecting us also, because maybe that earlier we used to come on the scooter, but now we need a big car. So that lifestyle inflation is also required to be met. क्योंकि अब हम इतने करोड़ों लोगों को ये नहीं कर सकते कि अपनी इच्छाएं खत्म कर दो. उसकी वजह से भी अगर मान लो ऐसा भी होगा तो कहीं ना कहीं इकोनॉमी ग्रो नहीं होगी. So we need to maintain the balance between this lifestyle inflation as well as our earnings, whether our investments, whether our wealth is actually going to meet it or not. तो वो भी आपको प्लानिंग करनी पड़ेगी. आप अपनी डिजायर्स पे भी कंट्रोल अगर कर सकते हैं तो करिए, नहीं कर सकते हैं तो देन यू नीड टू प्लान कि यार मैं मेरी डिजायर्स को कैसे फुलफिल करूं with proper wealth planning, wealth management, wealth creation. So I think it was very well explained by CA Suraj Singh as well as supported by our senior partner Jay Kumar ji on wealth creation as well as the wealth management. And this month, particularly for the month of August, we shall be taking various topics. Next week, maybe on Friday, it will be on UK taxation. So Tejwani ji and their team also deal in this subject, and of course we should also learn. And we will take care of these hiccups which came today on technology. So we are thankful to the entire team of JKT for giving this presentation. And now after this, there will be a quiz. Quiz is there or not?
Yeah.
So we will have a quiz on this. Rohan will be sharing with all of us. I will be sharing with in that Saturday webinar group so that it can be shared with JKT team also, and thereafter we can conclude. So far as this webinar is concerned, we can close the webinar. Thank you.
Thank you. Okay.